Markets across Asia are in freefall this morning. The K-Vin's down over 6%. Oil has surged past $100 a barrel and is now closing in on 110. This is not a drill. A perfect storm of compounding risks is hitting global markets all at once. And what happened last week will not repeat itself this time. Let's start with what's driving this collapse. Over the weekend, Iran's hardline faction seized control of the country's military command. This single development has shattered the market's assumption that the conflict in the Middle East would be short-lived. Investors had been pricing in a quick resolution. That bet is now off the table. For those with deep experience in markets and geopolitics, this moment echoes something terrifying. The war in Afghanistan, America's longest foreign war, even longer than Vietnam. A conflict that dragged on with no clear exit, no clear resolution, just an ever-deepening black hole of uncertainty. That same feeling of being pulled into the unknown is returning now. And when that kind of fear takes hold, the response is universal. Sell everything, raise cash. It doesn't matter if it's stocks, gold, silver, or any other asset that's been riding the wave up. When uncertainty becomes this extreme, even so-called safe havens get liquidated. Gold is down 2%. Silver is down over 3%. The only thing people want right now is cash. Now here's something critical that most analysts aren't talking about. Oil at $100 isn't just a number on a screen. For Asia, particularly for countries like South Korea and Japan, this is an existential cost problem. These nations have no alternative energy sources that can replace crude oil at scale. When oil surges, their input costs skyrocket immediately. That means even if revenue stays flat, profits get crushed. And if oil stays elevated, or worse, climbs toward $150, analysts will have to completely rewrite their earnings estimates. That process doesn't happen overnight. It creates weeks, sometimes months, of downward revisions and uncertainty. The market hates nothing more than not knowing where the floor is.
What makes this moment especially dangerous is what has been building underneath the surface for the past 17 years. Think back to 2008. The subprime mortgage crisis nearly destroyed the global financial system. After that disaster, regulators promised reform. Markets cleaned up. New rules were put in place. But here's the thing about human memory. It fades. Within 2 or 3 years after 2008, the same financial engineering that caused the crisis came back. They just changed the names. Instead of mortgage-backed securities, they repackaged risk around data centers, IT infrastructure, and various alternative assets. The shadow banking market, the private credit market, it all ballooned again. Leverage structures, complex derivatives, the same playbook with a different cover. And here's the crucial part. Normally, recessions serve as a reset mechanism. They flush out the bad debt, the over-leveraged positions, the fragile structures. But since 2008, we haven't had a real recession. COVID in 2020 was a health crisis, not an economic one. Central banks flooded the system with liquidity and prevented any meaningful deleveraging. So instead of getting cleaned out, the risks just kept piling up. 17 years of accumulated fragility. And now, when war pushes uncertainty to extreme levels, and the shadow banking sector starts showing cracks, you don't just need cash to reduce risk exposure. You need cash because the very assets people thought were safe might suddenly not be. When collateral gets reclassified, liquidity evaporates. This is exactly what's been happening over the past 2 to 3 days. Two forces colliding at once. First, the need to reduce risk assets because of war and geopolitical uncertainty. Second, a liquidity crisis brewing in the shadow banking system, where margin calls and collateral requirements are suddenly spiking. Both forces demand cash. Both are accelerating at the same time. And almost nobody in the media is explaining this. Now, let's talk about what institutional investors have been doing. They saw this coming. While retail investors and foreign ETF buyers were piling into Korean stocks during the recent rally, institutional players were selling into that strength. They recognized that the rally was running on fumes, on momentum rather than fundamentals. Today, they feel vindicated.
And here's the math that retail investors need to understand. Last week, the buying power that pushed stocks higher, call it 100 units, has already been partially spent. Those buyers used up a significant portion of their ammunition during the rally. Maybe they're down to 50 units now. So even if they wanted to buy this dip, they simply don't have the same firepower. The cavalry isn't coming this time. If you're sitting there right now thinking, well, it crashed hard last week and then bounced right back, so maybe I should buy the dip again. Stop. Take your finger off the buy button. This is not the same situation. Last week had two drivers, weakening fundamentals and rising oil from 65 to 70. But there was still buying power in the system to absorb the shock. That cushion is gone now. Let's talk about the elephant in the room, stagflation. The employment data that just came out is genuinely troubling, not because of some minor technical weakness in a subcategory, but because both high-quality and low-quality jobs are deteriorating simultaneously. The K-shaped economy narrative, where tech workers thrive while everyone else struggles. That story is breaking down. Even computer science graduates can't find jobs now. AI is replacing human workers across the board. When both the top and bottom of the labor market weaken at the same time, the assumption that the upper tier of the economy would carry everyone through simply collapses. Normally, weak employment would push interest rates lower, which provides some relief. But oil at $100 prevents that. This is the textbook definition of stagflation. Growth is falling, inflation is rising. Interest rates can't come down because oil-driven inflation won't let them. And rates can't go up further without crushing an already weakening economy. The stock market's single greatest fear is exactly this scenario, and it's no longer theoretical. The logic for stagflation has materialized right in front of us. Adding fuel to the fire, concerns around AI spending are mounting. Reports are emerging that deals involving OpenAI and Oracle aren't going as smoothly as expected. Meta may end up being the last one standing. When you combine AI uncertainty with the war premium and stagflation risk, the very earnings forecasts that made Korean stocks look cheap on a PE basis are now in question. So when someone tells you the KOSPI looks cheap on a price-to-earnings ratio, tune them out. Those earnings estimates were built on a world where AI spending kept growing and oil stayed at $70. That world no longer exists. And on a price-to-book basis, Korean stock aren't even cheap anymore after the recent run-up. The valuation argument for buying right now has no legs to stand on. Here's what you need to do right now. Reduce your risk asset exposure significantly. We had already cut our position to 40% last Friday, and even that isn't enough given what's unfolded over the weekend. We're now moving to 10% risk exposure. If you're a large fund manager with 100 trillion won, even cutting 1% means $1 trillion of selling. That kind of volume takes time to absorb, and prices will keep falling until it does. If you can't fully grasp every detail of what I've just explained, that's okay. Even 70% of professional fund managers in the industry wouldn't catch all of it. But you need to understand one simple truth. The things you don't know about this market have been growing every single day for the past week, and they just got dramatically worse over the weekend. Think of it this way. You were walking on solid ground. Now you're walking through a minefield. In a minefield, you don't run faster. You slow down. You check every step. You assess your own strength, your emotional state, your current positions. Before trying to understand the environment, understand yourself first. That is the priority right now. Stay safe, stay liquid, and we'll navigate this together.